Hello, everyone, and thank you so much for joining us today for Carter's webinar on building lasting limited partner relationships. We know that LPs are the cornerstone of any fund, so let's talk about how to build, maintain, and manage those relationships with a panel of true experts. I'm going to introduce our panelists right now and then ask them each to also say a few words about themselves and their backgrounds. So first up, we have Joanna Rupp from the University of Chicago's endowment.
Hi, Rita. Thank you for the introduction. I'm Joanna Rupp. I work for the University of Chicago's investment office. We oversee the endowment, which is about $10.5 billion, and we have a $3 billion allocation right now to private equity. And our private equity the target is half venture and half buyout. Given the strong returns from venture and the lack of liquidity, we are overweight venture versus that target right now, but it's been a good problem to have mostly.
Perfect, and we'll get back to that later in our conversation. Next up, we have Peter Lacalade from SCS Financial. Peter.
Thanks, Rita. Yeah, Peter Lacalade, SCS. We are a multifamily office headquartered in Boston with about $30 billion under management from approximately 200 ultra high net worth families. I lead our private investment program, primarily spend my time doing buyout and venture capital investing or buyout venture growth funds, as well as direct co-investment deals, but also oversee our kind of opportunistic credit and real assets portfolio as well. And similarly to Joanna, I would say, a typical family at SCS is about a third allocated to private investments, and also have a similar 50-50 or so split between buyouts and venture growth.
Perfect. Thank you, Peter. Next, we have Evan McQueen of Ninja Capital. Evan?
Hi, Rita. So Ninja Capital is a single LP investment platform representing the controlling shareholder of Shark Ninja, the home appliance company, vacuums, blenders. So I represent the other end of the spectrum from Peter and Joanna, certainly. We exclusively invest in tech and early stage privates, so seed and pre-seed and seed funds on the venture side, early growth equity on the growth side, and then only micro buyout on the buyout side. And we also do about 10% of our allocation is to directs. My background is I was a direct investor for about 10 years, both growth and early stage venture capital, and then I was an operator, CFO, COO of a database company, and then I've been on the LP side for a few years now.
Perfect. Thanks for joining us. And finally, we have Henry Ward, CEO of Carta. Henry?
Hi, everyone. I'm Henry. I'm the co-founder and CEO of Carta, and I'm just here because I help hopefully build some of the software that helps everybody manage their LP and GP investments. So great to be here.
You've also raised over $1 billion from inception to current day for Carta, and so curious to dive into that as well. And lastly, I'm Rita. I lead Carta's venture capital and private equity business development team. By way of background, I was a fund formation attorney at Latham before joining. I teach a course on venture funds, so very excited about what we can discuss today on GP and LP relationships. I know most of the people watching today, when you were registering, you had the option to submit questions. Many of you did. So one thing I'll flag from the very beginning is many of those questions actually were baked into the conversation flow today. So watch out for that. A few of them we've saved for a Q&A portion at the end, but please feel free to dive into the chat and ask anything else. And if we have time, we'll keep an eye out there and try to get to that as well. To kick things off, I think many of you already started talking about this in your introduction, which is perfect. But what I'd like to start is kind of setting the stage for what we see as current trends in the market today. So curious for each of you how you are allocating generally across venture, private equity, and other asset classes, and how that's changed in the last 2 years.
I'm happy to start. I went back in preparation for this and did some counts. And 2023 was a slow year for us in venture. We only invested in 5 GPs, and one of them was new. And I contrast that with in 2022, we had 24 GPs come back to us. 21 come back, and we had 3 new commitments. So our portfolio is driven by when our partners come back, and certainly the VCs in our portfolio came back in 2022 and not 23. We're seeing more of them coming back in 24. The other thing that has driven it is we have seen a lot more buyout managers, and because it's been a tough fundraising environment, we've been able to tranche our capital into our buyout managers, and oftentimes write the first check into the fund, then give them time to fundraise, put some assets in the ground, and then write a subsequent check. We've also been a lot more active in secondaries in this environment.
Peter, Evan, curious about your allocation and if that is similar or different from Joanna's experience.
Well, yeah, I would say similarly to Joanna, it was really kind of, I'd say in 21 and then maybe the first half of 22, there was just a ton of activity in venture capital and growth equity raises, and also a lot of co-investment activity as well, which kind of mimicked the overall kind of deal environment. And we were, we tried to be measured about it, but it's still the capital deployment timeline for a lot of our managers condensed to about a year, from maybe the 2 to 3 typical year deployment. And what actually was interesting is a lot of the funds that were the venture capital funds that were raised in maybe raised 12 to 18 months ago are just starting to activate now. So we actually, while we might have committed to something a while ago, if you think about like the way the capital was called, we set up vehicles where we pull our families together. And so we actually moved some of our commitments that we might have had investment committee in November of 21 into our 23 vintage to align the actual capital deployment with the underlying vehicles. Buyout exits have slowed down a bunch, but the deployment and fundraisers has been more steady. We spend most of our time in lower middle market buyout investing. Say companies with 3 to 10 million of EBITDA. Fund sizes between 100 and 500 would be a sweet spot for us, and so those are less impacted by the credit markets, at least on the deployment side. You might not get the big multiple arbitrage at the exit from the mid and large cap groups, but we've been relatively try to be relatively consistent about the way we approach deployment and strategy, and think that having an edge in having a barbelled approach where we have leading buyout franchises and leading venture franchises, that are kind of one end of the barbell, and then the other end being these small niche emerging managers or seed funds, early stage funds. That's been a hallmark of our program for over a decade, and I think has served us well. So we try not to chase returns, and we also try to be measured in thinking about doing the bottoms up work, but also top down and making sure we're not getting too overexposed to certain areas.
Yeah, and for us, I would say the evolution we've evolved quite a bit, but it's less about a response to the markets and more indicative of just the evolution of our own strategy. The LP that backs us was a lot more opportunistic previously. We invested in some kind of larger brand funds out of the gate, and in the last year and change, we've refined that strategy to be exclusively small funds, emerging managers. So on the seed side, 10 to 100 million $10 to $100 million funds, so quite small. On growth equity and buyouts, really sub $300 million funds. So we're really playing on the more aggressive end of the market to target kind of potentially. Our goal is to generate top decile returns. I suspect we won't, but not everyone will be. But that's the kind of the target we're swinging for.
And maybe to continue off of that last point, Evan, with the sweet spot of funds you're looking at and the sheer number of funds you're looking at, when GPs are looking at fundraising and speaking to LPs, maybe what advice do you have for those managers as they're going through the fundraising process?
I think first is finding the impossibles, figure out the impossible task of driving urgency with LPs. I don't have an answer for that, but that's always the question. And we've seen different strategies. I don't know what works other than just being genuine. And other thing is just, we've talked to over 400 managers last year as a very small team, which was too many, candidly. This year we'll hopefully talk to half as many or 2/3 as many. But really, it's just like, how do you stand out? Like with this seed, especially on the seed landscape, there's like thousands of firms, right? Like, how do you showcase your edge in terms of sourcing insights, value add access? On the growth and buyout side, it's dramatically different, especially at the end of the market we're playing in. The number of qualified micro buyout funds and early growth equity funds, I mean, it's like, tens maybe versus thousands. But there aren't many LPs that really play in that space either.